Depreciation. The word alone makes most people's eyes glaze over. But for the rich, it's basically free money. Today, we're breaking down how investors use depreciation to save huge sums on taxes, and how understanding it can help you too. Depreciation is the IRS's way of saying things lose value over time, and we'll let you deduct it. It's mostly used for business assets and real estate. If you own a rental property, the building itself, not the land, loses value according to IRS tables. The government lets you deduct that loss from your taxable income, even if the property is actually appreciating. Yes, you heard that right. You can be making money while writing off imaginary losses. Let's say you buy a rental property for $300,000, excluding land value. The IRS might allow you to depreciate the building over 27.5 years. That's roughly $10,900 per year as a deduction. Even if the property grows in value, you can deduct this loss every year. It reduces your taxable income, meaning less tax paid today. Here's the beauty. Depreciation doesn't require actual cash leaving your hands. Your property might be increasing in value, collecting rent, and still giving you a tax deduction. It's like having your cake, eating it, and then deducting the calories. There's one catch. When you sell, the IRS may require you to pay depreciation recapture taxes. Think of it as paying back some of the deductions you used. Even with that, smart investors often pay less overall tax than if they hadn't used depreciation at all. Depreciation isn't just for real estate. Business vehicles, equipment and machinery, office buildings, furniture and fixtures. The rules differ depending on the asset type, but the principle is the same. The IRS allows a portion of the asset's cost to be deducted each year. The rich use depreciation strategically to reduce taxable income, offset rental or business income, and keep more cash flowing for reinvestment. By stacking deductions, they can legally reduce tax bills by hundreds of thousands or even millions over time. Even if you're not a millionaire, depreciation works for real estate investors with rental properties, small business owners with vehicles, equipment, or office assets, anyone buying long-term assets for business use. The key is tracking assets and using the IRS tables correctly. Mistakes can trigger audits or missed deductions. Depreciation equals IRS deduction for the wear and tear of assets. Real estate is the most common and powerful example. You can reduce taxable income even while making money. Used strategically, depreciation is a massive tool for wealth building. So next time someone says, taxes are unavoidable, you can smile and say, not if you know how to depreciate. Track your assets, claim what's allowed, and reinvest the savings. Hit like, subscribe, and keep learning how the rich make the rules work for them. Because here at Monarch Stick, every move counts toward your money crown.